You recently said there's only 15 investors that know how to consistently make money for LPs. That's a very small number of investors. And
especially
why
when
did you?
three of them are on this call, you know?
Yeah.
Maybe there's closer to 20. Maybe I underestimated it. So
Yeah.
I'm willing to be corrected there. You have to be comfortable with yourself. You have to not be ultra self-absorbed. You have to have the polymathic ability to like rebuild a model from scratch for every new business, every new entrepreneur you're meeting. And not many people on the planet have that.
Tyler and I got really excited about getting Geoff Lewis on the podcast for a couple of reasons. Number one, he is an investor by profession, but he's an operator by founding Bedrock. And so he checks both of those boxes. He also is in with, I would argue, the best list of founders from any of the recent firms. Sam Altman, Parker Conrad, Guillermo, Garrett, like these are incredibly influential companies. And so getting to have Geoff talk about what he looks for, what he sees, how he invests is something Tyler and I were really excited to dive into.
Yeah, Jeff's a special talent. You can tell from Twitter and some of the interviews he's done. We're stoked to have him on the IO podcast, and we're going to cover a bunch of stuff that I don't think he's talked about before. So hope you all enjoy it, and thanks for tuning in. All right, so first question's this, Geoff. In a kind of interesting time in venture capital right now, you're seeing like every fund, maybe even downsize, struggle to fundraise. And then here comes Bedrock a few weeks ago with an announcement that you're going to raise your fund size. So talk about that. How are you making that decision in a time where that doesn't seem to be the normal case? Why'd you decide to do that? What was the rationale? Walk us through it.
Sure. Well, we've already done it, so it's already completed, and definitely was a unique move. I think maybe one other firm that I'm familiar with has done it over the past sort of decade, and I think it's just sort of been the two of us that have done it. I mean, it really stems from what's worked well for us. And so, you know, we founded the firm in sort of late 2017, launched it in 2018. And over the past 12 months, we've had a really nice window into what's worked versus what's not worked for us over all of these, not all of these years, but coming up on 6 years now. And one of the things that has really worked is we believe correctly concentrated capital into some of the very best private technology companies. So companies like OpenAI, like Vercel, Rippling, Flock Safety. And in order to sort of keep running that strategy, particularly in this environment that we think we're in now for the next several years, where you really can't count on high velocity follow-on financing rounds from other VC firms. You really need to be, you know, our whole ethos is sort of in search of narrative violations. It's on my t-shirt. I think you have to be ultra counter narrative now. I think very few of these startups actually grow to the scale that you really need to drive the venture outcomes. So we just wanted to make sure we'd have enough capital in Bedrock for our newest fund to both, you know, make several investments in these companies that we think are going to become transcendent. And then importantly, really back those entrepreneurs round after round after round and size each of the rounds such that they're large enough for them to really get to the next milestone. Frankly, without having to rely on like syndicates. Like we love working with other investors. We love collaborating with folks. We're totally down to do that. But we want to make sure that we can do an entire round for an entrepreneur we really believe in if no other firms believe in them.
So Geoff, how did that go over with LPs? Obviously, it happened relatively quickly, so the answer is they were in. But what were the questions, or how did they think about that as a strategic partner there?
Well, it's super unusual, so it's nothing that's done very often. I think it was doable for us because the fund that we upsized is our newest fund. It's a 2023 vintage, and just a small portion of it has been deployed. And most of that capital has been deployed into one company, OpenAI. So you basically have a dynamic where you could have the upsize structured, where the new limited partners coming in are coming in at a NAV that reflects the sort of trajectory that OpenAI has had since we made that initial investment via Bedrock 4. So your existing investors aren't really getting diluted. Their exposure to that position isn't getting diluted. That's part one, is we structured it from a documentation standpoint to avoid diluting the LPs who backed us earlier with Bedrock 4. And then part two is the folks that we brought in are just highly long-term strategic limited partners for the firm as we look ahead and think about where Bedrock is going to be going over the next 5, 10, 15 years. It made sense to sort of add just a few really long-term strategic partnerships. And luckily, our existing LP base understood it. They got it. They understood the rationale. They know our strategy is concentrating capital onto the top few companies. And quite honestly, for running that strategy, our fund sizes are pretty small relative to the very small number of other firms that also do a capital concentration strategy. So it made sense. It was pretty non-controversial. And we mechanistically, you have to get the approval of all of the LPs to do it. So you have to actually go through a formal process to make a change like this. And I'm grateful that we had the high conviction limited partners to pull it off. And we did it all in a few weeks. So I'm happy about that.
Geoff, you've probably, while you were talking, it comes to mind like maybe the two most fascinating stories in tech over the last 18 months are the Rippling fundraise that Parker put together in the middle of the whole, what was the impetus there? It was like payroll SVB collapse. And then you have more recently the OpenAI, the crazy week. Were you involved in both of these rounds of financing? And if you are, I'd love to hear kind of the stories of both if you're open to sharing.
Yeah, absolutely. I mean, we were invested earlier in both of those companies. So Rippling, yes, as an investor and as a stakeholder was involved on the periphery of both of those. And yeah, I mean, with Rippling, I think what Parker pulled off, he raised $500 million over a weekend after SVB collapsed, and it was unclear during that sort of 48-hour period of time whether what was going to happen, whether it would get bailed out or what was going to happen. And that, to us at Bedrock, is just an extraordinary example of why we hang our hat on assessing entrepreneurs. Like some firms differentiate on, we understand a specific market sector better than anyone. Others are like, we're really good in this specific, nuanced technology. Others are like value add services. Bedrock is we assess entrepreneurs. And the Parker story and the Sam story, which we can get to in a second, for us, like no one else on the planet, in our view, could have pulled off raising $500 million in a weekend when the bank that banks over half of the tech startups in the United States, something like that, collapsed. So that's a testament to Parker. I was of the mind that maybe he was being like 1 degree too paranoid, but in raising all that capital, I'm like, okay, it was like a lot of capital. But he got it done on good terms, and I think history will have proven that was a very wise move. And ultimately, we always defer to the judgment of the entrepreneurs here. And then the Sam thing was really, for me, funny and interesting. We've been invested there since 2021, so it's been a while. I've known Sam and Parker both for like a decade plus at this point. And when the news with Sam came out, I was actually, I was pretty chill about it. We of course had folks reaching out and asking what the heck is going on here. But my theory was that somehow Sam would end up back at OpenAI and things would end up in a better spot than they were before. The issue, the risk with OpenAI when we invested was the really unusual governance structure. It was sort of a known risk. We flagged it internally before we made the investment decision, the original one in 2021, that, hey, this is a real risk. And again, we hang our hat on thinking we're really good at choosing the very few entrepreneurs who can navigate through just extraordinarily difficult situations. And I think Sam did a nice job of that as well with OpenAI. So kudos to Sam and Parker.
So let's talk about this a little bit. When you talk about assessing founders and that being a superpower of Bedrock, what's your actual process for doing that, and what are you looking for?
I mean, look, the reality is there is no real process for it. The way in which we do it is spending just a tremendous amount of time getting to know these folks. And so oftentimes, and those are two extreme cases where with both Sam from OpenAI, Parker from Rippling, we knew both of them for over a decade before we, invested. That's extreme. I'd say the minimum is like several quarters of getting to know an entrepreneur or a set of co-founders, the team they've built. If it's just one or two people, really intensively getting to know them, trying to understand what makes them tick. And you sort of try to assess them as people, and you assess them through their vision for the company. And then you sort of triangulate the market, you triangulate the technology story with that. But the starting point and ending point for us is the entrepreneur. So you just can't shortcut it. It takes a lot of time. And this is why when we look back to I was so frustrated in sort of 2020, 2021, when you had all of these rounds happening so quickly, everything was over Zoom. And, the rule that I tried to implement at Bedrock, I wasn't 100% successful at it, but I tried my best to implement it, was no investments where we only have met the people on Zoom. So I was very religious, quasi-religious about no investments unless we've spent time with the people in person. And then I think we had maybe one or two exceptions to that rule, but we generally did a good job of implementing it, which led to us not pacing as fast as other firms during that time period in terms of dollars out the door, which I think set us up really nicely for Bedrock 4, our newest fund, where a lot of firms are having trouble, unfortunately, raising their next fund, is where they just deployed way too quickly in 2021. And we didn't fall into that trap, luckily.
That's awesome. So you mentioned spending time and you can't shortcut it. As you're spending time with these folks, what are some triggers of you're like, oh yes, this is someone we want to be in business with? What are you looking for as you get to know them?
Let me add on to that real quick, Geoff. Sterling and I have this phrase we'll use when we meet someone that starts to vibe with us, where we get conviction that they're special. And the phrase is, they're using the right shibboleths. It comes from the Old Testament, and it's a Jewish word that means they're saying things that make sense. It's a Hebrew word. They're saying things that are almost secretive, that people know. And if they say it the right way, you know that they're special. So do you have any trigger points, as Sterling calls it, or shibboleths, where you're like, yeah, these guys are the right type that I want to work with?
What are some of your shibboleths?
Sterling, you want to start? I can share some. Oh, yeah, for sure. So I think anytime you find somebody who the chip on your shoulder, like you have something to prove, and most of the time they kind of completely made it up. They don't actually need more reputation or more. It's just how they tick. Like they are on a mission to prove that they can do very difficult and overcome the impossible. I think about people who they play the game because they love it, and they work really hard because they love it, not because somebody's making them do it or there's some external force. And there's a couple, but those are two that come to mind as we're thinking about some of these entrepreneurs that Bedrock's invested in.
Yeah, adding on to that, they usually, because they love it, are by nature workaholics, because this idea of work-life balance it's like my life kind of is my work. They kind of blend together, and so they're playing a broader game than people who view things through a work-life balance lens. And the way they talk tend to kind of convey that. I would say those are a few of the shibboleths we talk about. Any of those resonate, Geoff? What would you add?
Well, I think they both resonate. I'd put a little bit of a spin on them, and then I want to actually challenge the notion of the shibboleths altogether, although I do like the Old Testament a lot. But I want to challenge it in the context of entrepreneurs. Look, I'd say the work-life integration, where the work and the life are integrated into this healthy, sort of cohesive one. I think that's what the best entrepreneurs ultimately achieve. It's really hard to get there. And so I think it takes, I don't think entrepreneurs start out with any work-life integration. I think it's all work. These truly transcendent entrepreneurs, it's all work. But ultimately, to continue building and actually do this for year after year after year, decade after decade, ideally in these like extreme cases where it really becomes their life's work, you need to figure out how to integrate your family, integrate your life, and make everything healthy and synergistic. And so I definitely agree with, work-life balance is kind of a narrative mirage, but I would call it sort of work-life integration, something you want to seek out. And then, I call it vengeance, Sterling, the chip on the shoulder thing. I just, also a little bit biblical, I think, as a concept. But I like to see some element of they feel wronged in some way. That's idiosyncratic to me. Not everyone at Bedrock is obsessed with this in the way that I am, but I like to see some sort of something in their history where they can articulate, I felt wrong by this. It could have just been like something didn't go their way in the world. It could have been, someone that they worked with sabotaged them or something like that. I think Parker's talked quite openly about how he felt quite sabotaged with Zenefits, his startup prior to Rippling, that sort of helped inspire him to get started with Rippling. So I like both of those. But on the notion of shibboleths, I actually, the thing that when I think about our best entrepreneurs in our portfolios, I actually think they're each like really idiosyncratic and N of one. And I think what maybe is most striking about it is how completely themselves each of them is. So when I think about, Garrett Langley from Flock Safety, like he doesn't pattern match. He's not like, oh, Garrett reminds me of this other entrepreneur. Guillermo from Vercel, Argentinian immigrant, created Next.js, then built basically a company, Vercel, on top of that. His story is like completely N of one. Like he doesn't have the way that he carries himself, the way he talks about the business, his vision over the next, 5-10 years, it doesn't match to anything else. And so I think like if there's a pattern that we're looking for here, it is just this hyper individualistic, idiosyncratic, and they're very comfortable with who they are. There's a school of thought in venture capital that you want to invest in sort of very insecure people. And I actually don't really subscribe to that. I think you want to invest in people who are, they might have a chip on their shoulder, something to prove, some vengeance. But they know who they are, they know what they're doing, and they're going to self-actualize in the world in a meaningful way through their company.
Yeah, I like that, Geoff, because to me, there are not the same shibboleths that get shared over and over again. The idea of a shibboleth is that somebody through their life experience has learned these principles, these truths, and then you pick up on them. But they're going to be different for every entrepreneur because they are unique and they manifest in a unique way. And then you just hit on something that lights me up every time. It's this idea of being very authentic and very true to yourself. If you like listen to a podcast and you try to, Geoff likes to listen for these 3 things, I'm going to learn those 3 things and tell them every time I pitch. It's ridiculous. And it doesn't work. It doesn't come off that way. I always tell people, if you're not being authentic, it's like trying to do a squat on 1 leg instead of 2. You don't have your base. You don't have your power. Whereas if you just show up authentic, you say the things that you believe and you articulate them clearly, you will attract the people that you're supposed to attract, and you'll repel the people you're supposed to repel. And so I think I'm just adding a big +1 to everything you were saying there, Geoff.
For other listeners to the podcast, and for Geoff's knowledge, we had Henry Ward, Cardus founder, on, and he said essentially a version of this where it's like fundraising is not meant to be a sales process. It's meant to be what did he call it, Sterling? A dating mechanism, a sorting mechanism.
It was like sifting, yeah.
Sifting, like are you on or are you off? I'm going to be who I am. Are you in or are you out? And he was going to be unabashedly who he was. And I think that's kind of what you're saying, Geoff, yeah?
Exactly. Actually, it's funny you mentioned Henry. That's actually one of the passes that I really, really screwed up. And back when I was an employee at another venture capital firm before starting Bedrock, Henry came in. I've been friends with Manu, who I think did his pre-seed.
Yep.
And Manu, I think, sent it to me first to look at. And Henry, I remember that meeting still. It must have been, 8-9 years ago now. longer probably. But I remember that meeting still, and he was completely like all cards on table. It's like, this is who I am. This is what I'm doing. I'm not, and he was an N of one idiosyncratic entrepreneur, but screwed up that decision and didn't do the seed round, unfortunately. But
Why not?
Yeah. Yep.
I mean, look, I don't actually remember all of the reasons why. I think that my colleagues and I think we had the sense that the TAM for like cap table management, I think we got stuck on the TAM and maybe missed the bigger story around expanding TAM, and then B, all of the ways in which you could expand that product beyond just like originally what they were doing, which is the digital cap table. So I think we sort of had the wrong intuitions on the market, I think was the reason that we passed ultimately there.
Got it.
So when you think about some of these things you've talked about with these amazing founders, like these are some of the best founders of our generation, and you're talking about vengeance, you're talking about N of one, you're like these authenticity, some of this stuff. Do those characteristics carry to the best investors? Like, would you consider yourself or the other firm leaders that you look up to? Would you say that those are the same types of things that end up making people successful in VC?
I think it's true for some of them. I think the certainly like the folks that I respect have pretty different styles. Like, there's a way to do VC where you're just hyper analytical. You sort of do a ton of due diligence, and that can sort of work really well. I think Neil from Green Oaks is really good at this, and he's someone that we have a very different style. We both do lots of due diligence, but I think his style is maybe a lot more understated, but just extraordinarily analytical. You have this small team of folks doing a lot of analysis and research, and that can work really well. It's less. I like that because sort of it's not really about the VC. It's not about the investor. It's about the entrepreneur, and so you take sort of a backseat to the entrepreneur. In practice, we do that at Bedrock, but like, I founded the firm, and part of what I like to do is just be myself and share things that I've learned along the way here. It's been a rocky road to get to this point, and so I want to help entrepreneurs where I can. And really, the way that I think about venture is there's sort of you can be a partner at a firm, and that's awesome, and that's a great thing. That's a great path for lots and lots of folks. You can have an amazing career. You can do great stuff. Starting a firm from scratch is a totally different Pandora's box. And so there's I believe Bedrock's a business. It's a different type of business than the businesses we invest in. But I think about Bedrock as a business. And so I feel like there's a level on which the founders of these venture capital firms can actually relate to the entrepreneurs they're investing in, maybe on a slightly different level than if you're not, an entrepreneur yourself. And so, Vinod at Khosla is another one of these folks I really look up to. Kirsten Green at Forerunner. She's really different strategy versus us, but, entrepreneurs love her. And all of these are folks who founded their own venture capital firms. So, I mean, it's brutally hard. I'm not advising anyone to do it, but I think you can relate to the entrepreneurs a little differently if you've done it.
You were not new to venture when you founded Bedrock. Like you'd been very familiar with it, and it sounds like it still might have even been harder than you thought it was going to be. Did anything surprise you, like the level of difficulty of actually getting it off the ground?
It's been like 10x harder, an order of magnitude harder than I thought it would have been. And it's so funny because like from the outside looking in, everyone's always just like, oh man, like you just had it like easy street here. You worked at Founders Fund, like it must have been so easy for you. It's been complete easy street. And like, you have no idea. You have no idea. But whatever. I think everyone who founds a business, it's always a difficult journey, and it can go in different directions for different folks. I'd say the thing that there were lots of things I knew were going to be really hard, like fundraising. I knew was going to be really hard. Building an actual, identity as a firm beyond just myself that could stand the test of time. I knew that was going to be really hard. Making great investments. I knew that was going to be really hard. But there were all of these like little things that I completely didn't really think about. Like, for example, getting the decision quality to be the absolute best that it can be on every decision, not only the investing decisions, but like decisions around how we operate the firm, decisions around how we engage with our entrepreneurs after we've invested, decisions around investor relations, decisions around how you structure, nuanced terms in your funds or in your vehicles. I didn't realize how many decisions would have to be made on like an everyday basis. Like I probably make 20 or 30 decisions a day of varying like importance. And one of the things that's tricky when you're actually operating and managing a venture capital firm is you can get lost in the small decisions that don't really matter. There are lots of decisions where, you can undo it. If you get it wrong, you can sort of fix it. You can change this and you can change your mind. I think Bezos has talked about this a little bit. I really like this idea of
one-way doors,
what are the
two-way
few
doors.
really big decisions? And I think it's his, so I'm sort of aping it from him, this idea. But what are the few really big decisions that can't be reversed and getting those right and actually getting decision quality high has been the biggest challenge of starting a firm, because there was no like process for how you make decisions day zero.
Fascinating. I would guess one of the most important decisions you've got to make, and I'm curious if you agree, especially given your strategy to be highly concentrated, is when to follow on, when to pile in, when to double down. How do you make that decision? How do you get the conviction to, because the case against it's fairly clear, like the cost basis is higher. You're now not as diversified. How do you make that decision as high as quality as you want it to be, Geoff? What have you learned there?
We've learned that you have to underwrite it as if you're looking at the company for the first time, and so that's kind of the mental model that we try to engineer here. And obviously, you're going to have a bias because you already know the company, and if you're thinking about doing a preemptive follow-on financing, you're going to be probably positively biased if you're actually even talking about it. You have to try as much as possible to re-underwrite it. So where we have done this, where we've done it with Flock Safety, we've done it with Vercel, we've done it with Rippling, we've done it with OpenAI, and I think all of those are instances where we got it right. And in each of those instances, we did sort of a full process, a full new analysis with the ground truth today versus when we originally invested, and we re-underwrite every round. Our bar is 10x cash on cash. And so that is like what we're trying to get high conviction on internally. So that's part one. Part two, and one of the things we've flexed over the years is just how the decisions ultimately get made. And where we've landed is actually consensus. Just we don't believe in it here at Bedrock. And some firms have a consensus approach and it works really well for them. Our approach is not really about consensus anymore. It's about you have one decision maker.
Wow. So if you don't love a deal, but another partner there does, they can pound the table and get it through. Am I hearing that right?
They can do that has happened and will continue to happen because look, the reality is I'm the only GP here at the firm, but we have an extremely talented young team of 3 other folks on the investment team. And I do think that you sort of have to make investments to learn what works and what doesn't work. Now, we don't want to lose money on these learning investments. So I'm going to heavily weigh in on things. But for, early stage pre-seed seed investing, yeah, like even if I'm not there on it, I'll take a flyer on someone on the team because I believe in the team that we've assembled here.
Got it.
How do you think about when to dive in and do that work? You're talking about re-underwriting it, but are you doing it basically when the founder goes out to fundraise and you kind of look at it new? Do you try to preempt them going out and running a process? Because as your strategy is to concentrate all this capital on the best companies, how do you think about the timing of when to dive in and do that work?
When something major has changed that like we think we've seen before other people. And so in practice, that means we typically are catalyzing these follow-on financing rounds. We're making them happen earlier than they otherwise would. Sometimes at prices that, might be a little bit ahead of where the business is at because we get that ultra high conviction. And so, in the case of Vercel, we're Series B investors. Then the worry we had when we did the Series B was they had no enterprise business. It was all just this long tail of small customers that were paying. They had tremendous usage, like insane love and adoption amongst the developer community, but they didn't have an enterprise sales motion or enterprise go to market. The minute we saw that snapping together and saw them landing enterprise contracts in sort of first half of 2021, we knew that all of the other pieces for a transcendent company were there, and we leaned in and we preempted, catalyzed the Series C. I think we invested $35 million. They ended up raising $100 million as part of that round, and that business continued to just grow astronomically since then. Similar story was true with Rippling. Similar story true with Flock Safety. With Flock, actually, the thing we saw was when we initially invested, they were selling this product initially to homeowners associations. And Garrett, the entrepreneur, and I would often talk about, cracking sales into actual police departments at the city, state, federal level is just really freaking hard. They spent like a year really trying to hone the playbook for how to do that. And then we saw them really starting to crack it and ended up concentrating a lot more capital in that business in 2020 and then beyond because we felt that people were just systematically underappreciating once you crack police sales, like how sticky that can be, how huge a TAM that actually is. Like, didn't want to repeat the mistake with Carta, where it was like sort of thought the TAM was small, but it was actually massive. Think the same thing is true with Flock. And then I think we had a unique view on crime being a really big problem in the United States that maybe technology could help to solve. So, yeah.
I just want to call attention to part of what it sounds like your process is here. You are paying such close attention to these businesses that you've already invested in, that when something new happens, you can be very, very early to take advantage of that. Because if you wait, well, everybody starts to see that, right? And I don't know, that seems a little against the conventional wisdom of kind of like set it and forget it, and you look at it again if they get another term sheet type of a mentality, right?
That's a really good point, Sterling. I do think we hyper focus on, because we are so concentrated, we can actually keep in close touch with really all of our core positions across all our funds. And yeah, when something changes, we really dig in and are like, okay, how material is this change? Is this a step change? If it's a step change, to what extent has the value of the business increased? And we want to be the earliest person to act on a step change. So I'd say like that's kind of the follow-on strategy when we're preempting a follow-on round. It's like we decide there's a step change, we validate it through work with the company, through diligence, and then we want to be the first to act on what that step change means.
I think it's an exceptional process, and I think it's very, very wise. Some of the other investors who I really admire, they talk about it as like diligence starts after your first dollars go in if you're doing it right, because it's your chance to concentrate so much more money. But it takes next level conviction, because everybody else, you want somebody else to price that and mark that up. You want somebody else to validate that the business is doing super well. And I don't know, it just takes an extraordinary amount of conviction to follow that strategy. How do you have that at Bedrock? Because it's either like concentration, it means a thing. It's either a spectacular success or a spectacular failure. Yeah, exactly.
Wait, what do you say, Tyler? You stuck something in there. I didn't hear it.
Yeah, sorry. I was just agreeing with Sterling that you're either dead right or you're dead wrong when you're following on to lead and not waiting for the market. So yeah, I love the question of how do you get to that conviction, because you're going out on a limb.
Yeah, I mean, if you're just to put a point on this, which you guys are 100% right. To put a point on this, if you're dead wrong, your firm is dead probably.
Yeah.
If you're putting, in Bedrock's case, we've got something like 50% of our dollars that we've invested in the entire history of the firm are in 5 companies.
That's amazing.
So that is extreme capital concentration. Look, I mean, I think it stems, every one of the companies we invest in is in some way a real reflection of the entrepreneur. I think Bedrock's a reflection of me, and I'm a high conviction person. And, when I decide something, I go after it 100%, and I'm going to give it my all. And I think we apply that in a different mode to the follow-on investing, where when we have conviction in an entrepreneur in a business, like, we're willing to just go out on the limb. I think a big part of us being able to get there, though, beyond all the diligence, beyond all the analysis, beyond all the customer calls, when we're doing this capital concentration, it is, we feel like we've really underwritten the entrepreneur. And so we feel like we have a model for how that entrepreneur is going to react and manage through the inevitable challenges that are gonna hit them in the face down the road. Like, I remember thinking with Parker at Rippling, when we did that big round when the macro was crashing in 2022, after having been invested for many years in that business, one of the qualitative reasons why we did it was a feeling we had that in a world where the macro was extremely unstable and crashing, you needed someone like Parker who was going to be able to navigate whatever crazy stuff was going to come that company's way. And that got proven right, through the way he navigated the SVB crisis with catalyzing that round. Similarly in the case of OpenAI, our thesis on Sam as an entrepreneur has always been, Sam is just absolutely next level at talent. He's a talent magnet. I mean, every great entrepreneur is a talent magnet, but Sam is another level of talent magnet. And our belief was that he's just going to be able to get all of the best talent to OpenAI, and that's really what matters. If you're going after AGI and these large language models, and then ultimately the talent doing the petition to bring Sam back, I think kind of helped that business navigate the craziness a few months ago. And so we can concentrate capital more comfortably because we are building high conviction in the entrepreneur before we build high conviction in the company. Does that make sense?
Makes tons of sense, yes. You've said something twice, Geoff, that I would regret if I didn't ask follow-up, and you said it on CNBC too. When all the news broke about Sam getting fired, you said you were zen about it, and you're like, you figured it would work out. Why? Where did that zenness come from? Because there's no way you could have known the team was going to rally and bring him back, or was that really what you thought was going to happen? Where'd the comfort come from?
Well, look, I'm not a prophet, but we did have a sense that you sort of want to wait and see how things unfold in certain situations, and that was one of them. I think the comfort, though, more just spiritually, esoterically, came from there's how we want to operate, how we want to work as investors, as a business here at Bedrock, is we want to do everything in our power to make the right decisions, to do the right thing wherever we have an ability to move the needle, to make a decision, wherever we have agency, we want to give it 100%, and know that we've left nothing on the field. We want to give it everything. And then there's just situations in the world where you really can't do anything about it. So in a situation where there's something crazy going on with this nonprofit board that we're not on, and there's really actually not much we can do other than, with the company maybe dialoguing or being a sounding board, there's not really much we can do. we tend to be somewhat zen about it. And that was an instance where it's like, okay, this is going to play out. We really believe in Sam, and let's give it a few days and see how it plays out. And it turns out that our belief was well founded.
Love that. Before we get into some of these hot takes, Geoff, I want to ask you one other question on investing. You recently said there's only 15 investors that know how to consistently make money for LPs. That's a very small number of investors, and maybe you're using hyperbole. I don't know, but
especially
why
when
did you?
three of them are on this call? You know.
Yeah.
Maybe there's closer to 20. Maybe I underestimated it. So
Yeah. What do these guys and gals have in common, Geoff? Why did you say that? And what the observation stem from?
You know, I do think it's just a way overstaffed, over-resourced, over-funded, niche area of finance. If you think about what venture capital is, it's kind of, there are only a small number of companies that will ultimately truly change the arc of society, will truly change the world, and will be highly profitable over decades. And that's kind of what you're looking for as a venture capitalist. And actually, what happened in the last cycle was you had just a ton of crap companies dumped on the public markets, and that's probably poisoned the well on exits in the public markets for the next few years. But what we try to do is, what are the companies that are going to be around 20 years from now, that are going to really endure? Can we get in extremely early, and can we pick the few in every fund that are going to be the best of the best and concentrate dollars into that? And I think in order to do that, there's a level of like, you have to be comfortable with yourself. You have to understand different types of people. You have to not be ultra self-absorbed. You have to be open to being proven wrong, open to like overcoming biases you might have had. You have to have the polymathic ability to like rebuild a model from scratch for every new business, every new entrepreneur you're meeting. And not many people on the planet have that. And so if you think about like, who has that like first principles thinking, that polymathic sort of instinct, and then decides to get into venture capital somehow, and then is able to build enough of a track record over a long enough period of time where they actually have access to the best venture investment opportunities, and then can effectively pick the best ones. That's not that many people. And then frankly, there always is just this issue of, at a certain point, you're not motivated really by the money as much. You sort of like, yes, we all want to make great returns for ourselves and for our limited partners, but at a certain point, you have to be doing this for a reason beyond just the money. And I think in general in finance, most people are like super mercenary. And so the people who are actually, beyond mercenary are actually more mission driven, that are also polymaths, that also have a track record, that are also venture capitalists. That's a small number of people.
Love that.
You've had a few of them on your podcast though. Like, Keith at Founders Fund, Gary now at Y Combinator, I'd count them amongst those 15.
Well, we're hoping to get all 15 in the next year or so. So we'll get.
We'll need a list. We promise we won't share it. You just send us the list though.
I actually don't know who they all are. I have maybe five or 10 that I think are on there, but I don't know who they all are. And quite honestly, it rotates. It rotates. It's not like it's a set in stone list forever. Like, there's probably one or two new folks who break onto it every 3 or 4 years, and people rotate off of it.
I mean, if you just think about it pragmatically, it makes all the sense in the world. You know how many companies that are started end up making a dent in the world. It's a very finite number. And, it stands to reason that it's the same thing. If you're building this iconic franchise that can repeatedly raise funds, deploy, return capital, it's just not that many people on the planet. It just isn't.
All right, last 10 minutes or so, let's get into some hot takes and see if we can have some fun discussion here. There's a theme of some of your hot takes, Geoff. I'm curious what you think of this categorization. One of the themes I think is almost like this. You've got a sense that things are potentially going to go south, and you have a little bit of a doomer prepper in you. You've predicted hyperinflation. You've predicted Franz Ferdinand moment for World War III. I think you've tweeted about creating a farm and getting off grid. Like, where's this coming from? Why do you feel this way?
No, I think I have a general sense that things were pretty stable societally for a long time, and then there's a way in which the combination of social media usage, the degree to which folks are sort of brains are being sort of algorithmically rewired, plus some of the macro stuff that's happened, starting really with COVID, now layering in a lot of geopolitical uncertainty in both the East and in Europe with Russia, Ukraine. I do just think that there's just going to be much change. There'll be a lot more change than people think through this combination of sort of technology and geopolitics. And so I generally think there's just going to be a lot more change. And I think that that's going to be very hard for folks to navigate. There's almost a way in which you either want to be a really small, tight-knit team and in a business context, small, tight-knit team to navigate this, or you want to be like a huge oil tanker that just can't sink. Like, you want to be just a massive organization. But I think sort of a mid-sized companies are gonna have a tough time. And then I think on an individual level, I just think, people have different base perceptions of reality now in a way that I just don't think has been as true historically in my lifetime.
I always think it's fascinating because when you can't really agree on what facts are or what truth is, like, where do you go from there? And that seems to be, from my point of view, one of the interesting things that's happened over the last few years is if I don't like what you're saying, I just brush it off. It doesn't matter if it's a fact. I just consider that to be Geoff's opinion. And when we can't debate from a basis of fact and reality, things get weird fast.
Yeah, exactly. And that is where we're at societally. So that is scary.
Everyone's watching their own movie almost, and we're convinced our movie's right, and social media is confusing it even more. And to your point, geopolitical tensions are not helping. So we're all on different pages. I think that's the root cause, or at least part of it.
You talked about the algorithmic rewiring of brains, and it's a very eloquent way of saying it. What do you think? Would you ban, TikTok? What do you think about the future of these social media companies and their role in society? How do you think about that?
Well, actually, was I think one of the first people to say we should ban TikTok back in 2020, when one of my first temp checks, my short video series that I sunsetted earlier this year. But I said it in 2020 that we really should ban TikTok. So yeah, I don't actually necessarily know that it's ever going to happen. But I certainly think that the power that algorithm has to shape the minds of its users is unparalleled. And I think it's very scary that it's, affiliated. The U.S. company, at least, is historically been affiliated with one of our geopolitical, the U.S.'s primary geopolitical rivals. That's alarming. But yeah, I think all of these things are unhealthy if overused. I think X is pretty unhealthy if used too much. I sometimes use a little bit too much, then I have to pull myself back. I think Instagram is very unhealthy if overused. I think anything to the extreme on social media, on algorithmic engagement, I think can be pretty unhealthy. And we don't know exactly how to navigate this as a society. It's going to take probably decades. It took a long time to figure out how to navigate the printing press. It's going to take a really long time to figure out how we navigate this whilst regaining our health societally. I think is going to be very challenging over the next few decades.
Geoff, can we get your prediction on the venture capital space kind of as a whole? You've shared that you think it's way overstaffed, overfunded. You have people like Josh at Lux saying he thinks half of firms could disappear. How do you think this whole industry shakes out over the next few years? What will it look like in 2030?
I think it's just the winners win even more, and so I think there's still a opportunity to become, if you're an emerging manager or new at this, you still do actually have a window to become a quote unquote winner. As a young person getting into venture today, there still is a window, but it's just this bifurcation where you just have the entire bottom 50% probably goes away, but then the winners win even more, because the dynamic is I don't think like the limited partner demand for venture has or is going away. And so I just think you somehow have more AUM concentrated with sort of fewer managers. And historically, the way that firms have done that is you sort of scale up the team really significantly as you scale up AUM. And I think the real trick, and I think that degrades returns. I think the more investors you have on the team, the worse the returns will be for like a whole set of reasons that I could do a sidebar on, but we probably don't have time. So the actual thing is, how do you scale AUM without adding too many people to the investment team?
Gosh, I actually would love a mini sidebar on that.
Yeah, let's do it. Yeah,
because the argument, Geoff, would be it's not the head count that matters, it's the AUM that you have to return. And the larger the fund size, the harder it is to do that, which is why Founders Fund and others are cutting their fund size. So why are you saying it's the head count?
Well, I think it might be both. And so let's sort of get at this from a few different angles. I'd say on the team size, like I said earlier, like you kind of have to make investments to learn how to invest. And so you can't really have a functional investment team unless folks are empowered to at least sort of, lead, maybe one deal per fund or something. And if you have an investment team of 40, 50, 60 people, which some firms do, I think there is just this incentive to deploy the capital. You have to get the cash out the door, and that's completely the wrong incentive. And in fact, it's probably much better to have the reverse of that, where actually you get rewarded, you get more carry, you get bonus or whatever by not investing. That's probably like the right incentive structure. But no junior VCs want to do that. So I think scaling up the teams is really dangerous. And then in practice, you can't really scale AUM that much unless you really do scale up your team, because LPs want to see a certain, AUM to investment team member ratio, investment partner ratio. So I think that's one problem. I think your point is right, though. Yeah, returns do degrade over a certain fund size. And so I think it is inevitable that returns will degrade in venture, because I don't think the LP demand for venture is going away. I think there's a few years right now where it's going to be really hard, but I think that we come out, 4 or 5 years from now, this back where we were in like 2020, before it got 2021 levels crazy, but LPs still want to put money into this asset class. And there's going to be fewer firms and fewer managers that survive the shakeout that we're in for now. So I don't know, something's going to give, and I think it's probably going to be returns degrade.
So we've got a couple questions that we wrap up with typically, Geoff, but I want to ask one before we get to that. Bedrock has some of the most iconic founders of like our generation, and they're only going to get more and more prevalent as time goes on. How do you convince people like that to take your money over somebody else's, to work with you over somebody else? What works?
Well, it was harder when we were just getting started, and honestly, all that we had going for us back then was interpersonal chemistry and showing high conviction. So, in the case of Flock Safety, I got on a plane to Atlanta. The company just closed their Series A. We'd missed it by like a few weeks, and we, sort of sat in a conference room, Garrett and I, and talked about what could you do with an additional $10 million, and then ultimately catalyzed a sort of preemptive Series A1 at a $60 million valuation back in 2018. And there's stories like that of like things we had to do in the early days to really get entrepreneurs to take us seriously, to work with us. At this point, we're in a privileged position. I hate the word privilege. We're in a good position, a blessed position, Sterling, because as you said, we do now have these transcendent entrepreneurs in the portfolio that other folks can call for references, et cetera. So we're finally at the point now, 6 years in, where we have that like every firm talks about like flywheel. It's so hard to get a flywheel. And then once you have it, things just actually get a lot easier in terms of access. And we finally have the flywheel.
Amazing. Awesome. All right. We do have a couple questions, but I have one more too. You tweeted, numbers go up, numbers go down, but your vibe is your constant. What's your vibe, Geoff? Why do you always talk about vibe and you're not a venture capitalist? That seems to be part of your ethos. What does that mean?
Well, the vibe thing, I talk about it because it's something no one can compete with me on, because sort of your own vibe as a human, your vibrancy, your the way that you are in the world, that's unique to you as an individual. And so, I'm not going to be for everyone, but if there's interpersonal chemistry, if things resonate, it can be a very powerful partnership with entrepreneurs. So, and then the not a VC thing, I really do think that it's an industry that is insecurity is kind of an emergent property of the venture capital industry. And so most of the VCs have never started a company. They've never been an entrepreneur themselves. They are in these very Game of Thrones like firms where you sort of are always jockeying for, one incremental degree more influence or power to like have a little bit more input on decisions. And you have these really long feedback cycles on whether the investments you've made as a partner are actually going to be good investments, are going to work. And you're not actually really building anything. Long-winded way of saying it's pretty hard to self-actualize as a venture capitalist. And through the process of building Bedrock, I do actually feel like I've, in a professional sense, self-actualized, and I'm not insecure, and therefore I don't consider myself to be a VC.
All right. And by the way, I think that's spot on.
It's the theme of the whole convo, honestly. Don't you both think? Like, it's N of one, authenticity is what attracts you to the right person, both as an investor and an operator. I think that's the theme that tied the whole thing together. Who's an investor that you admire most? Who's an operator that you admire most? And then we'll pause there. And if you can't pick one, that's fine. But who do you look up to in both?
I'd say on the investor side, I actually think Bezos is an incredible capital allocator. I haven't had the privilege of like sitting down with him one-on-one, but I just think like the AWS move that he made in like 2008, 2009 was genius. I think all of the ways in which Amazon strategically invested to expand their surface area. I respect that, like, when you have that much wealth to just like go for it on like a moonshot literally thing with Blue Origin, even though like Elon probably is like going to eat his lunch. I respect that he's doing that later in his career. And so he's an investor that I look up to, although I don't think people really think of him as an investor. And then what was the second question? I forgot. I sort of
operator, an operator you really admire. We've talked about the four cornerstones.
We maybe should make Geoff go outside of his portfolio, though. So we asked this question to everybody, Geoff, and Parker is far and away the one that the most people point to.
Really? Okay,
Yes.
That's awesome. Okay, totally outside my portfolio, where like we have no Bedrock exposure, would be Gwen Shotwell at SpaceX. She's the COO of SpaceX. And has really just been, I think, instrumental in that company's success. So she would be an operator I admire, who Bedrock has no exposure to her amazing work at SpaceX.
So Geoff, we have a term, and it's called the golden spur. And it's like, what makes you the way you are? What is your underlying motivation for showing up and doing this? And so what's your golden spur, Geoff? Why are you the way that you are?
Wow. I mean, I think a lot of it stems back to childhood and sort of specific experiences I had a pretty difficult childhood, a pretty difficult family. I love my parents very much. Things weren't always easy for us. And I think I had to tease out very early in my life, like how to find the truth about things, how to figure out what's true versus what's a lie, as a sort of a unique characteristic of my upbringing. And that's really led me on this quest for truth seeking that kind of has been my thing. And the way it manifests professionally is through the not a venture capital stuff. But that's a big piece of it. And then the other thing is, like, I grew up in circumstances like my parents were both public school teachers, super middle class. I didn't start out my career in tech. I was working at Procter and Gamble in brand management. So I took the long way around to get into venture capital, to get into technology. And at this point, I just feel like everything's sort of bonus round. Like it's all just for the love of like what we get to do every day. And that's like powerfully, it gives you a lot of agency when you're like, okay, great. This is bonus round. Like this is like more than I ever would have dreamed like I'd be doing at this point in my life. So that's motivating as well.
All right, Sterling, let's recap. What are your top few takeaways from Mr. Geoff?
I think the number one thing that stands out to me is the importance of conviction, and why build a business or a strategy around like hedging your bets. And Geoff has to be one of the highest conviction guys you've ever met. He in every part of his life, right? He gets conviction and he acts on it. And if he's right, he's right. And if he's wrong, he's wrong. And it's led to some really cool learnings. And I think that was super impactful for me.
I think that's probably the top one. Or this, we talked about it at the end, this theme of authenticity. It reminds me of a Naval tweet of you escape competition through authenticity. And Geoff kind of just oozes this. He's comfortable in his own skin. He's going to say what he wants. He's going to tweet what he wants. And he's going to attract people that are attracted to that. And that authenticity ends up being kind of a moat for your entire life.
Well, because I actually think those are the same thing. The conviction and the authenticity, it's the same word. It's the same principle that we're talking about here, right?
Totally agree. The conviction piece is the follow-up to when you're authentic, you're able to do things with boldness. I think that's the message you're saying.
Totally. I was very curious just because Bedrock does have so many marquee founders at this point, people who are building these generational and amazing companies. And it's always interesting how people diagnose that. And for him, it's just a lot of time in the saddle, getting to know these people, getting to understand them. And he's not trying to make them all look the same and sound the same. He's just trying to see if they uniquely have what it takes to go out and bend the curve, dent the world a little bit.
Yeah, my last thing that maybe I'd connect to other episodes is like, where's the alpha here? And to me, I would say Geoff's got alpha in identifying exceptional founders, probably better than others, largely due to the work that he puts in getting to know them. And then secondly, there's this theme he kept coming back to of if he identifies a step change quickly, he'll catalyze around. You call it preempting, whatever. But he's creating a round that he leads. That he's not waiting for the market to get to consensus. He leads. So he's non-consensus.
And you heard him. He said, sometimes what that means is I have to be a little more aggressive on price. I have to go a little earlier. And so there's these two buckets of like a reactive investor and a predictive investor. And he wants to be a predictive investor. And he knows that means you actually have to predict. And then you have to be correct. And I really thought that was all fascinating.
And he had clear eyes about if he's wrong about this stuff, your firm dies. Like he's betting the firm in the same way Reed Hastings bet Netflix when Andrew Ratcliffe was talking about that.
Totally.
He has that founder mentality.